Anton, thanks for having me on today.
Uh, it's a pleasure to have you with us today. Why don't you give us some background about yourself as well as the business you're in?
Sure. Well, I started investing way back in 1993. My wife and I were just doing single family homes back then. So for about 10 years, because we didn't know that you could buy different types of properties different ways, we just did buy and hold from about 93 to about 2003. Around that time period, I met a couple of mentors. One of them was a gentleman named Robert Allen, which a lot of people have heard of. He wrote a book called No Money Down. It kind of put him on the real estate investing map. So my wife and I paid him a lot of money, learned how to do other investments. So we learned how to do fix and flips through him. We learned how to do wholesaling through him. And we also started our learning process into apartment investing. And so during that process, I actually met a couple of other partners who all had the same focus. We wanted to go out and do bigger deals because you can do single family homes all day long, but we weren't really doing anything creatively or on a bigger scale. And I got tired of doing one here and one there. So got together with my partners and started going out and buying larger projects. So our first project was a 98 unit property that we bought into. About the same time, we also partnered with a developer that was going to convert a 344 unit apartment complex, A-class apartment complex in Tucson, to condominiums. So we raised money and partnered with him on that. And so that was in the early 2000s, like 2004, 2005 timeframe. And so since then, since about 2005, I either own or have owned a little over 2,000 units to date.
Very good. I think you also, with all your experience in investing, you have started your own coaching program since then.
Yes. Yeah, that's something else that I did too. One of the things that I learned from taking some of these other classes from other people that are out there is they seem to give you some good information, but maybe not a lot of good information or what you can really use to go out and actually start investing right away. And you, like us, we ended up making a lot of mistakes as we went through the process because there were things that we didn't realize we needed to know ahead of time. And so we've learned from those mistakes. And part of that process was us deciding that we were going to start up our own training program so that we could actually give people good quality, in-depth information on a variety of different topics. Now, certainly over a 4-day period, because we do a 4-day boot camp, there's still some stuff that we can't teach because we can't cram, as I tell people, I'm going to take 28 years of investing and I'm going to cram what I think is the best of the best into 4 days. There's still some stuff that doesn't fit. So, but you've got a good, strong foundation that you can utilize to go out and start looking at properties, analyzing deals, and of course, making offers and buying stuff.
Yeah.
Buying apartments, buying mobile home parks, buying storage facilities, office buildings, retail spaces, pretty much anything commercial in nature.
Yeah. So just to give you kind of our listeners a heads up, right? We with our business, obviously we arrange financing for commercial real estate across the country, and multifamily is a big piece of that. And we know all the coaching groups that are out there, the good and the bad, and we talk to a lot of students, obviously, that have graduated from these programs, and so we receive a lot of feedback, the good and the bad, and I would say one of the elements that we hear from your students is that it's compared to some of the other programs they have attended, is that it's a much more in-depth approach to coaching, and that they actually walk away with much more hands-on knowledge rather than just the typical, oh, here is what you can do at the high level. And obviously everyone talks about the same success stories, but that you really provide a foundation that someone has the ability to go out and start out on their own, always realizing, and you have mentioned it, whether it's 3 days, 4 days, it's impossible for someone who has not been in this segment do it, to go out afterwards and think that they can do it by themselves. The reality is either you partner up with someone who has already done it, or you have a mentor who is helping out with whatever you plan to do. And I think that is really always a success. And we have talked to a number of your mentoring students, and obviously they're also very happy because they have that direct hands-on support that you provide compared to some of the other programs, right? So there is no element of that we pitch any type of program, but I think it's important for our listeners also to understand whenever you pick a program that there are so many different approaches to coaching, and it's really important that you really understand which program fits your personality, and also whether you really get what initially was being told, what you are going to get. Do you get a real coach who is working with you, or do you just get a junior coach that then does handle you on the side, who may not even have the experience than the main coach does? So it's just kind of a side note here, because that's really always important when we talk about coaching. There are good ones and there are not so good ones. And whoever wants to join a coaching program, it takes a lot of work to investigate the various coaching groups. And we have heard a lot of positive feedback about Anthony Chara's coaching and mentoring program. So it's only one that you also should at least investigate.
Well, thanks, Anton. I appreciate I appreciate the feedback. We've always strived to have the best coaching out there, and that was, excuse me, one of the things that I was looking for when I decided to start my coaching program. I went out and talked to other people that had been in competitors' coaching programs, and I asked them what they specifically liked about the program, or what they didn't like about the program. And the two things that came back again and again from different people was, number one was the time. So a lot of coaches out there, you have a specific set time slot, whether it's a half an hour, and that's it. That's all you get. And then the other thing that I heard from multiple people was that they felt like they had more experience than the coach that they were getting. One guy in particular was trying to close, it was either a 20 or 30 unit property, and something just didn't feel right with his coach. So he asked the coach, because again, some of the gurus out there, what you do is you just get a coach, and you don't necessarily know what their background is. So he decided to ask him about his background, and found out that he closed on a triplex like within the last 6 months. So here's somebody who closed on a triplex coaching somebody who wants to buy a 20 or 30 unit apartment building, not even in the same planet, right? It's just completely different vehicles or properties that they want to purchase, and different ways to go about purchasing them and analyzing them and everything else that went along with it. So when I heard that, I went out to some of my students who I knew had done deals and had done them well, and that they also understand how to communicate and how to use the spreadsheets that we utilize, and educate their students or potential students at that point on what to look for, and what are the warning signs, and what are the good things that you want to find when you're analyzing a deal. The other thing that I asked them too is, because of the time issue, I specifically asked them if they would be okay doing pretty much an on-demand coaching program. So it wasn't set to a half an hour here or an hour there. It was about, are you available to help your student whenever they need help? Now, certainly there are guidelines that are put on that. They're not going to be having calls at 10 o'clock at night or midnight unless that's their choice. I actually have one coach that he does some of his best work really late at night. So if he's got a student that wants to meet at 10 or 11 o'clock at night, he's okay with that. Personally for me, I'm not. My wife would be kicking me out of the house if I was on coaching calls on a regular basis that late. So it's just a matter of the coach and the student setting a time together. And if they set aside a half an hour, and they need more time than that, if they've got a hard stop, if the coach has a hard stop at the end of the hour, before they get off the call, they'll set up the next time they're going to get together, which could be later that day or the next day or a couple days later, just getting each person's schedule to work. If they don't have a hard stop, they'll stay on longer than an hour if need be to analyze deals and talk about the different things that you need to go through on the deals to analyze them properly in order to be successful.
Yeah, it's a very good point, right? When we talk about these time-based coaching, let's say an hour for time times 1 hour, whatever it is, right? The reality to this is that 10 hours is just not enough for someone who just starts out. And if you have a deal that is a little bit tricky, there are a lot of back and forth discussions that need to take place. And so then you have one deal, but what happens with the next one, right? And that, I think, is very often the struggle that a lot of coaching students have, that they feel that they get just the initial feedback, but then they have to run on their own. And we on the financing side then see a lot of these accepted letter of intents, or even in a worst case accepted purchase and sales agreements, where we tell them, look, your assumptions are completely off, right? And then it's too late, because very often they already have gone hard with earnest money, and now there needs to be some way of rescuing them, which you definitely don't want, particularly when you pay for a coaching program and then you do not really get the support that you need.
Yeah, that can definitely be a problem. So we try and show them both the plus side to every deal that they're looking at, and also talk about or think about the potential downside. What if, it's great that the seller says, oh yeah, you can raise the rent $100 a month. Well, maybe that's accurate, but how do you prove that? You prove that through a variety of sources, talking to local property managers that are going to be managing the property or potentially managing the property for you, looking on different websites that actually list the different rental rates. You also have to take into consideration, in order to get that $100 a month increase, do you have to do anything else to the unit? Is it just a matter of, snap your fingers, change the lease, and it's $100 more? In some cases, that's all you have to do. But in other cases, you might have to put $2,000, $3,000, $5,000, $10,000 into the unit to get the rent up $100 a month. And then you have to look at what I call a cost benefit analysis. Does it make sense? Does it make sense to put $10,000 into a unit to get a $100 a month increase? To me, the answer is no, absolutely not. When I'm looking at my cost benefit analysis, I want to make sure that I get my money back based on the increase within 5 years. So, or 60 months. So in other words, if I do my research and realize that if I, let's say, upgrade the kitchen, and if I upgrade the kitchen, I can get an extra $100 a month. Well, if I take a $100 a month increase times 60 months, that's $6,000. So if I can do the kitchen remodel or upgrade for $6,000 or less, I'm going to actually get that in the budget, and I'm going to slowly start going through methodically through each unit and upgrading all the kitchens. If I can do it for $3,600 or less, which would be 3 years, I'm going to do it tomorrow. Because if I can raise the rent, put $3,600, and as soon as it's done, raise the rent $100, and it's only going to cost me $3,600, I'm going to get that done much, much faster in order to increase my income and increase the value of the property. And that's one of the things that we teach our students when they're looking at different units. Do you have to do any repairs or upgrades to get that raise, that increase in rent, or not? So you have to, there's so many nuances that go into this deal, as you're well aware of, Anton, that it'll boggle your mind, all the different directions you can go to be successful, or quite frankly, miss a big opportunity or possibly lose money if you miss something.
Yes, makes all sense, particularly in the current market environment, right? When we look at 2010 to 15, it was easy to buy a property and make a lot of mistakes in the assumptions. In the current market, there is just no leeway to make those mistakes. So when you assume, oh, I think I can raise rents by $100, you better check and back check and check again whether that is really achievable with suitable comps, and not just whatever the listing broker tells you or anyone is telling you. You mentioned the property management company. This is one of our biggest challenges with particularly some newcomers, where they've come up with all their nice performers, and we ask them, okay, so where have these rents as well as the expenses been validated by your property management company? And in most instances, the answer is no. Right. So where do you get the validation from? Is it CoStar? Is it the listing broker? And you mentioned the seller, which is obviously the worst situation. Or is it just your hope by picking comps that may look like comps but are not your comps? And again, if you're new to this without a partner that has already been doing it, or a mentor, it's overwhelming for anyone to determine all these various facets there. So that's really the I see as one of the biggest problems, where a lot of wrong assumptions go into it. And then you have the other ones that they know that they stretch the assumptions, but they have to stretch them in order to make the numbers look good so that they can raise money from investors. Right. So that's then the other side of the coin.
Yeah, so people want to invest with them because they give them these outrageous projections of, oh, you're going to double your money in 3 years. Well, maybe they will, maybe they won't. But one of the things that I'll teach my students is that the information you get from the seller and the seller's agent, you take with a grain of sand, because they, to use a cliche, they have a dog in this hunt. They're trying to make the property look as good as possible in order to get you to pay maximum dollar to buy it. That's their job. I get that. So you need to corroborate this information with non or disinterested parties, like property managers that aren't managing it today, but they manage that type of property in that market. Or as you mentioned, CoStar, they're looking at, you can take information from other properties in the area through their rental rates, their expenses, their vacancy, and see if the information that the broker is giving you is accurate. Most of the time, you're going to find that the selling agent or the seller are going to, err on the really high side for income and things like that, and the lower side for expenses. And usually, somewhere in between is the truth of where you're going to be at with your particular property once you buy it.
Yes, definitely. And CoStar, right? CoStar is a great tool, but it's still a tool that you need to use correctly. So we have seen so many buyers coming in with using the standard automated CoStar report and picking comps from there. That's just not the real world, right? It's whenever an automated system picks comps, it's already a problem. And that automated system cannot really identify whether these comps have upgraded units as you plan to do them or not. And if they already have them, how much do you actually need to do the upgrades, right? So, and you mentioned, right, it can also go in the other way. If all the comps have never been upgraded and the rent, the comps may show that there is not really any rent upside with these, someone may walk away. Well, as there might be other comps that have been upgraded that would be the correct comps, and based on those, you should buy the property, but you never know about those, right? So, in other words, it takes a lot of effort just to find the right information and then build your pro forma based on the information that you collect. And it's hard work.
Yes, it is. And some people don't want to do the hard work and do that, the legwork that they need to do to talk to the people that they need to talk to, potentially even walk into some of the competitive properties and pretend you're a prospective renter and see what they're actually getting and what they've done. Have they upgraded the interiors or not? And based on what they've done, how much are they getting for rent? I mean, that's the best way to do it, is just by putting your own eyes on it. So you have to do the details, and some of the stuff that I teach my students to do, that they'll say, well, this is really tedious. One of the spreadsheets that I share with them is what I call a rent roll analysis tool. And what you do is you take every single unit and load it into the spreadsheet, and then you take every dollar that was collected every single month just for rent. So no late fees, no pet fees, no residential utility or ratio utility bill back for electricity or water, just straight rent for rent every single month for 12 months. So every unit, every month for 12 months for all those units. And then the formulas are set up to show you what they're actually truly collecting for rent from an economic perspective. Not we're 100% occupied perspective, because there's a lot of properties that are 100% occupied. That doesn't mean everybody's paying full rent every single month, or that they're paying it on time. So by putting the information into the spreadsheet, you can actually look at the calculations at the bottom, and it will tell you the true economic occupancy of the property and how much income it's generating. And there's a couple of times that we had properties that one said that it was at 8% vacancy. And by the way, I learned this because I got tired of buying properties and then finding out that we were struggling for cash flow. And it's like, wait a second, why are we struggling for cash flow? And it's, because all these people over here aren't actually paying their rent, or they're not paying full rent based on what the seller said that they were paying. So I created this spreadsheet so you could put the information in, and then right at the bottom, it tells you exactly how much you're actually collecting from an economic standpoint. So one property that was at 8% vacancy, or supposedly at 8% vacancy, actually had 22% vacancy. We had another property where, and you could, the other nice thing is too, is I color code it. So you can see I've got different color codes. There's red, yellow, and orange. So red means that it's occupied and someone's not paying rent, right? Because that's the worst. The worst thing you can have is an occupied unit where nobody's paying rent. Then we have orange. Orange is the unit's not rented at all. So that's a problem, because there's no income coming in because it's not rented. And then we have yellow, which is the unit's occupied, but the person that's in the unit isn't paying full rent for some reason, and we need to figure out why they're not paying full rent. And so when you see this color splash up on the screen and all the reds and yellows and oranges, you're like, wow, no wonder why there's a problem. And on the second one, the seller was trying to sell it to us with 5% vacancy. And when we looked at the numbers for an entire year based on what they provided to us from their rent rolls, they actually had just over 20% economic vacancy. So they were collecting about 79.5% of the income that they say they were collecting or should have collected, assuming that all the units were occupied and everybody was paying rent on time every month. And it's an incredible tool, but it takes a lot of time to go through that, especially if you have a large project. You have 50, 75, 100 units, and now you take that, every single unit has to be plugged in, all 75 of them, plus a minimum of 12 months. So that's a lot of data that you have to input, but I'll tell you right now, it is eye-opening when you actually go through that process and see what the true economic impact is. Because I've had sellers, after the fact, when I show them that report, they're like, well, yeah, but you're not taking into account the other income, the things like late fees and pet fees. Exactly. You're right. I'm not, because that has nothing to do with the income that you said you were collecting on the rent.
Yeah. It's a challenge, right? The good thing is, if it's a professionally managed property, and it's typically the larger properties, that information is more readily available, where the T12 is breaking it down by bad debt, the delinquencies, loss to lease, and so on. But only once you get into the smaller properties, that then it's really getting into a challenge. But we even have seen it with large properties, 100 unit, 200 unit plus properties, where the owners are not disclosing, even on the T12, delinquencies and loss to lease. So they just show vacancies, and in the worst case, they just show net rent collections. And there again, right? So now you need to go through that process you just have described. And that's really the only way to figure out how that situation has evolved over the last 12 months. Ideally, they are disclosing it, and then it's a much easier process. And you can then also back it up with aged receivables reports that they should provide, as well as bank statements that they should provide. But if they do not, then that's what you're describing is really the only way to get to the truth of what the story looks like. Right?
Yeah, absolutely. And I think the quality of the information you get too also does depend on not only the type of the operator slash owner, but it also depends on the number of units. If you're looking for
Absolutely.
if you're looking for smaller properties, 10, 12, 20 units, 30 units, a lot of times you get a mom and pop operation and you'll put in your offer, your agreement, your contract that you want them to give you the rent roll or what's called a tenant ledger. And
Yeah.
they'll look at that and go, well, what are those? Well, this is how you track how much people are paying you and when they're paying you so that you can see their true payment history. I actually had one of my students said he asked one of the sellers for that information and they said, well, we don't have any of that. He said, well, how do you track who's paying and whether or not they're on time or any late fees? And they said, well, obviously, if they haven't paid, then we would evict them. So if they're still living here, then they must have paid. So they didn't even track who was paying when. They just knew that if the person was still living in the property, well, they must have paid, but they couldn't tell us if they paid early, if they paid on time, or if they paid on the 10th or 11th or 15th of the month, but they're still there, so they must have paid.
Yeah. Yeah. It's not bad to be a tenant in that type of a property, I guess.
Yeah.
Yeah. Yeah. So I think one of my other pet peeves with all the coaching that we see is that everyone just talks about the successes, but not really also about the failures. Yes, some mention it that they had some failures in the past and then they recovered from all of that, but they are not really bringing up specific examples. It's more like, oh, I had a personal hardship, and I primarily they always blame the Great Recession, right? Kind of as a cover for everything, why things did not go well for them, but now everything is great. And the reality is, even in outside of a recession, things still can go wrong. And I think that's what we certainly miss when we see some of these coaching programs where there is just very little information that is also talking about not just the good, which lucky for us we had a great run in particularly in the multifamily market now for more than 10 years.
Yeah.
But no one really talks about the bad too, and I think that's a problem in my view.
Yeah, it absolutely is. And we've certainly had some bad deals. We've had some that didn't go as well as we would have hoped. We've had 3 that we've actually lost. And you mentioned about the Great Recession. Well, we did have one that we lost because of that. We actually bought into with the developer a 344 unit A-class apartment building that was going to be converted to condominiums. And what we learned from that transaction was, right, we bought it right as the market was doing this from about late 05 to 06 into 07 and 08. And what we looked at on the deal was, okay, we buy the property for X, we put Y into it, and we can sell it for Z plus. And we were looking at what they were getting for condos at that time in the Tucson market. Well, the one question we didn't ask is, well, what if the market changes? What if we can't sell them at that rate? Will the property be able to afford to pay the mortgage payment and the maintenance and everything else that goes along with it? And unfortunately, we got caught unaware because the market went in the toilet like this. People stopped buying properties. And out of 344 units, we sold 50 of them right away because you have to offer the units to the people that live there first. So 50 of the people bought them. Then another 50 were sold to investors who wanted to come in and buy them as investments. And then the other 244, a couple here or there were sold, but as the market kept going down, right, we're now chasing the market as the market is dropping like a rock, and we're never able to catch up with it. Well, the developer that we partnered with, unbeknownst to us, he actually had a little over 1,000 units in the area, the 344 we had, and then 2 other complexes. And what he did when the market started having issues is he went out and refinanced them. Well, the bank that he went to, and I don't remember the bank, said, well, we want all the properties. So he refinanced all 1,000 units together into one loan. And supposedly, as you know, people start getting upset when money's not coming back and people are losing money. Oh, well, this happened and that happened. Well, he didn't have the right to do that. Well, he did, because the operating agreement said he had the right to run the property and get loans and do what he needed to do to manage the property. And we gave him that right. But other people are saying, well, if he hadn't combined the other 2 properties, this one would have been fine all on its own. Well, that may or may not have been true. But the bottom line is you need to learn from it and you need to move on. And that's one of the things that we did, because what ended up happening is probably 2007, 2008, he got to the point where the payments could no longer keep up with the mortgage. We had $1 million balloon payment coming up. The market was still doing this. So he just kind of said, okay, sorry, I'm done, filed bankruptcy. And then pretty much the whole thing got wiped out. The bank foreclosed on all 3 complexes over 1,000 units. And we ended up losing ours and our investors' money that we put into the deal. And so that was one of the things that we learned the hard way. We didn't say, well, what if we can't sell it at the target price? Will it still be able to cash flow enough to pay the mortgage payment and take care of the repairs? And we didn't do that.
Yeah, good point. So you had 2 issues there. One is that obviously stress testing it to lower sales prices. The other one is, and I call it the curse of cross collateralization. That is always a problem, right? Once you have cross collateralized properties, your property might still work. I do not know in your case whether it may have survived, but there have been so many deals where one problem property can bring down all the others because of cross collateralization, right? So it's a problem.
It is. Yeah, I think one of the other pet peeves I have with some people that teach the different things that they teach is, and I do like a poll in my class, especially when I teach the financing section. I'll first off, I'll ask people, what does it mean if you have a recourse loan? Well, recourse loan means if things go wrong, they can come after you personally, whoever signs on the loan. Yes, correct. What does it mean if you have a non-recourse loan? And right, what everybody says, well, that means they can't come after you at all and they can only take the property. And I say, well, that's what everybody taught you, but I'm here to teach you the correct thing that you need to understand. And that is this, that within those non-recourse loans, they have things called carve-outs or bad boy clauses, which, Anton, you're well aware of these. You talk about them and teach other people about it, because it's a big issue with people that just think, oh, well, if I get a non-recourse loan, I'm safe. You're not. You have to follow the rules that are outlined in the bad boy clauses or the carve-outs, because if you don't, if you miss one of those key components, they will pierce that non-recourse ability for you, and now all of a sudden you have a recourse loan again. And so you should see everybody in my class. You'll probably have 90% of the people in the class will say, how many of you think that is true, that a non-recourse loan means that they can only take the property? And I say, well, that's what you've been taught. Now you're going to hear the full truth, and here's the rest of it. This is actually what you have to watch out for. And then I actually put up one of our documents that was on one of our loan documents that actually show the carve-outs that they have to agree to. And there's like 20 different line items. There's, obviously the obvious ones are fraud, right? You're not going to commit fraud and divert money and not pay your mortgage. That's pretty simple to understand. But there's other things as simple as insurance, making sure your insurance doesn't lapse, making sure that if you do have an insurance claim, you have to put the money back into the property to fix up the property. If the bank finds out you just pocketed it and said, oh, well, guess what? You just took a non-recourse loan and turned it into a recourse loan if you're not able to make the payments.
Yes, absolutely. One one of the items that is also in there are representations, right? And I think that is what a lot of sponsors as well as guarantors, particularly the guarantors that come on board just to be the financial partners, do not realize is that your representation when you sign on the loan may be correct, but do you know that all the other representations by the other guarantors, whether they are accurate? And if any of those is not accurate, then there is a reason why it can go into a recourse situation. And I can tell you that that's how I started out of school, right? So when I first came to the US, I was working out commercial real estate loans, and I can tell you we had a whole army of lawyers behind us that did nothing else but look for reasons to pierce that non-recourse clause in smaller loans, larger loans. And when we talk about smaller ones, there were maybe 5 million all the way to several $100 million loans. And in most instances, they were successful, right?
Wow.
Because you always find some form of a misrepresentation. And it's particularly the representation piece where a lot of people get caught, where someone just signs a piece of paper, but is not really thinking whether that representation is truly accurate, right? And that includes financial statements in particular, right? All that, every single guarantor needs to say, yes, my personal financial statement, my REO schedule, and everything else I provide is truthful and this is accurate, right? It doesn't take much to have an interpretation that it's not accurate, right?
Yeah, and the banks are also going to ask you to update that every year as well, because things can change. You might have a net worth of $2 million this year and have $500,000 liquid in the bank, but you get into another investment, something else happens, this happens over here, and the next thing you know, your net worth is now dropped to 900,000 and you only have 100,000 left in the bank. Well, you need to disclose that to the bank. That's one of the representations you're talking about.
Yeah, yeah. So in other words, pick your partners wisely, right? And when you sign on a loan, trust that all your partners are trustworthy too, right?
Yeah. Ask me how I know.
Yeah.
Now you were talking about deals that were lost and some of the downside, and this is one of the things I share in my class too. Is we had a property in Shreveport, and I had been trying to get my partner to take care of the property, to paint it, to put on new roofs, because the roofs were like a patchwork. You drive by and the first thing you see is these green roofs, but they were light green, medium green, and dark green shingles all over the place. It's like you could tell that there was a lot of patching going on. So I tried to get him to come up with a plan just to go through and do one building like every 6 months. And we had enough maintenance people. We had 3 maintenance people on the property because it was 150 units. They could have gotten up there and done the work. Matter of fact, they're the ones that got up there and patched some of the holes anyway. We could have had them come up and rip off the shingles and put down some new tar paper and then put the new shingles on over a period of time, like 6 months. And he didn't want to do it. He just said, nope, we gotta pay the investors. We got to keep the investors happy. Well, no, you got to take care of your property. We tried to get him to paint it because there were some areas where the paint was coming off the wood, and you could see where it was kind of bubbling a little bit. We need to get somebody up there to scrape it, prime it, and repaint it. Nope, we need to pay the investors. We don't have the money to do that. Well, I was harping at him for 3 years. Finally, after 3 years, this is one of the properties we lost because of oil prices. It had nothing to do with the economy. This was like 2015-ish. Well, the economy was doing great, but oil prices went from $100 a barrel down to 30 to 40. So when that happened and OPEC dropped the price to 30 to $40 a barrel, the main employers in the Shreveport area were oil and gas companies. Well, anytime OPEC drops the price of oil below $70 or $75 a barrel, they just shut down all their rigs. They don't need the gas, they don't need the oil. They'll just save it for later because they can buy it for less money from OPEC. Well, we ended up going from about 8% vacancy to 40% vacancy. Well, my partner missed a mortgage payment because it's hard to pay the mortgage when you have 40% vacancy. And so what happened is that triggered the bank to come out and do an inspection. So the bank comes out and does an inspection, and they look at the property, and the stuff that I had been harping at him about for years, now all of a sudden the bank came in and said, you're going to replace every single roof. And of course, my partner's argument was, but they're not leaking. There's nothing wrong with them. And they said, we don't care. It's our asset, right? It's our asset until you pay us back. And one of your carve outs is you're going to maintain the property to our specifications. So even though the roofs aren't leaking, they just look terrible. We want you to replace all the roofs. Oh, and we want you to paint the entire building, all the buildings. Well, what went from about an $80 to $83,000 quote back 3 or 4 years earlier to paint the buildings now turned into a $220,000 quote because the wood that he didn't take care of is now rotted and now needs to be completely replaced because he let it go too long. The roofs were another $500,000. So we went from missing like a $15,000 or $20,000 payment to now the bank wants us to put another $700 with late fees and penalties. It was like $750,000 that they wanted for that and maintenance to bring the properties up to their specifications. Well, at that point, he didn't have the money. We didn't have the money. The investors said, if the bank will work with us and do a workaround or a loan mod, we'll be more than happy to come up with the 750. And you know what the bank said? The bank said, it's a government insured loan. If we can't get it from you, we'll get it from them. We don't care. So either do the work or don't. If you don't do the work, we're going to foreclose. So the investors decided not to do the work, and they ended up letting the bank foreclose on the property. Mm-hmm. And so when you make the comment about know who you're getting into business with and do better research on your partners, that was one of the lessons I learned on that one was that this particular partner would not listen to anybody except himself. And even though I had been trying to get him to take care of it and take care of it and take care of it, he wouldn't do it. As a matter of fact, at the end, it was kind of interesting because he sent a letter to all the investors basically saying, oh, the bank is the bad guys and our residents. And he actually said our renters or our tenants, our gang banging, drug dealing, N-word residents don't care what color the building is or whether or not the roofs are nice and neat and clean and new. And it's like, I saw that and went, oh my God, I wish I had known that before I got into partnership with him, because if that's what he truly thought of the residents in that property, why did we buy it in the first place?
Yeah. Mm-hmm.
We never should have bought it if that's what he truly thought of the residents. So yeah, I've learned that lesson that I need to do a little deeper digging. And one of the things that I've decided to do is if I get into deals with other students, and sometimes I do, either me or my wife or somebody that I do know and trust because they've proven their track record to me, not just what I thought was a proven track record with this other person, but a proven track record because I've seen what they've done. They're the ones that are going to be managing that asset and running it for us.
Yeah, it's a very good point, right? Where you do not just hand it off to and hope that the asset manager does what he or she says that she is going to do. I think what you also another point that you raised there is, we need to pay the investors, right? So that was the main theme. And that we have seen that even during the best times now over the last few years, where we have certainly seen a similar pattern where they didn't raise enough rehab money to start with. So as soon as there is just the slightest tick up in rent collections, right? So yes, rents go up, but particularly delinquencies or higher, so the economic vacancy is lower than what they anticipated. So now they are running out of money. So now they need to feed the operations out of the rehab money that they have raised, which was already pretty tight. So now they don't have money left for any of the rehab that was planned. So it's a vicious cycle, right? So now we pay out the investors, we cannot really improve the property as what we said. The property deteriorates. We cannot raise rents. The tenant base will deteriorate as a result because the property looks terrible in comparison to a well-run property around it. And so it's really a vicious cycle that asset manager is entering into. And that we have seen that happening during the best times. Now we can only imagine if things flatten out or slow down, how many are in real trouble, right?
Yeah, absolutely. Because if you think about it, if you let, just like you said, Anton, if you let the property deteriorate and the outside looks bad like ours did, well, the good renters that want to stay in a really nice, clean place, they're going to see that and they're going to look and go, yeah, I'm just going to keep on driving. The only people that are going to stop are the people that know that that's the only place they're going to qualify to get into, is
Sure.
a place that looks like it's garbage.
Yeah. And the leasing manager will be desperate, right? Because they are pushed, oh, you need to fill this property, right?
Yep.
So the qualifications are also a little bit loosened up, right? So now you may fill it initially, but then you have delinquencies that go up. So
Yep, we've had that happen before too, where my genius partner and the property manager decided that they were going to lower their income requirements from 3 times income to rent to 2 times income to rent.
wow.
Why?
Yeah.
Because, well, now more people qualify. But if you think about it, let's say the rent was $500 a month. So your rent's 500. That means people have to make $1,000 a month in order to qualify to get in. Well, half of that's gone, which means they have $500 left over to live off of. That's gas, clothes, food, Xbox games, cigarettes, booze, whatever you want to call it, whatever you want to do, right? It doesn't go very far. But at 3 times rent, now it's $1,500. So if $500 goes to rent, now they have $1,000 to live off of. That $1,000 goes a lot further than 500. Or if you want to take the rent up, you got $1,000 unit, right? They should make at least $3,000. If they only make 2,000, half of it's gone, and now they only have $1,000 to live off for the rest of the month, as opposed to 3 times income to rent. And I get the idea. The idea is, well, but we need to fill up the units. We need to get rental income coming in order to pay the investors, pay the mortgage, increase the value of the property. The problem is, we learned the hard way when my partner did that. Because the vacancy, I was screaming and yelling because I'm looking at economic vacancy and he's only looking at physical vacancy. And it's like, no, you're not looking. Look right here at these numbers. The economic occupancy was something like 12%, and then it went to 13 and 14. And he's saying, oh no, look over here. We only have 6% vacancy. It's like, you're looking at the wrong stuff. I don't care how many units are occupied. I care how many are occupied and paying rent.
Yeah.
So at some point he must have got it, because it went to 13 to 14 to 15 to 16%. And I'm screaming and yelling. And then all of a sudden the next week I look at a report and we're back down to like 4% vacancy. I'm like, wow, where did that come from? And that's when I found out that he and the manager decided to lower the rental requirements to 2 to 1 instead of 3 to 1. They had 40 people move in. And within 2 to 3 months, 38 had either already vanished or were being evicted. Only 2 actually survived and were able to continue to make their monthly payments on time.
Yeah.
And so what happened was, our vacancy was going like this, and then all of a sudden it dropped. Our vacancy went down. And then when the artificial vacancy happened, where the 38 people realized they could no longer make the payments, all of a sudden our vacancy shot up, and we were at, I think it was 22% at our highest point.
Yeah.
And it compounded the issue. And now we have to start all over again, getting better quality people into the property.
Yeah. It's a problem, right? We talked about it initially. When you look at the property, that's actually also an issue, right? As an owner who is in the process of selling, you can easily cook your books like this and make it look better for a brief period of time. And what you have described is a perfect scenario, right? So you are pushing it into the sales process. You have a quick close, so everything looks great. Occupancy is in a great condition. The rents are great. But obviously the fallout from all these lower qualified tenants is not being seen until the buyer takes over, and then they have to deal with them. Right?
Yeah.
And that
Well,
happens with small properties. It happens with large properties. It happens all the time.
yeah, fortunately for us, I don't know if I say fortunately for us, at least he wasn't that unscrupulous that he was doing it to sell the property.
Right.
We were not planning on selling it. He was just trying to get the rental income up and the occupancy up.
Yeah.
So his intentions were good. He just didn't think through the whole process.
Sure. Yeah. Yeah, well, a lot of things, right? So here we go, right? So we have been talking about various aspects and just the small pieces really that all need to be considered. And we are have just touched the surface. So I would say, is exactly what we have talked about. It takes a lot of experience. It takes a lot of time to become an expert, right? And working with the right coaches and or partners is so crucial as a newcomer to be successful, right? And that's really key. So, Anthony, I really appreciate you having joined us today. How can our listeners reach out to you?
Yeah, well, thanks for having me on, Anton. I appreciate it. And before I give that information, just one other quick thing that I learned from one of my mentors was that he always taught me that you don't know what you don't know. So there was a lot of stuff that we learned the hard way because we didn't know that we should have asked certain things. We didn't know that we should have been looking at certain numbers and doing certain investigations when it came to buying our properties. So that makes perfect sense because that's where the experience comes in. You've got people that have been there, they've done that. Does that mean that we're perfect? No. There's still stuff that we learn as we go along. But we've learned a ton over the last 15 years. That's for sure. So people can get a hold of me at successclasses.com. Successclasses.com. We not only teach about apartment investing, but other avenues of that. We have asset management workshops, due diligence workshops, money raising workshops, and we also have a deal structuring workshop. So all of them are very, very good. And we guarantee all of your learning. We give you 100% satisfaction guarantee. So at the end of the learning, if you're not satisfied that the time and money was well spent, we'll give you your money back.
Okay, great. So what's the easiest way to reach you?
So there's two different ways. They can call our office, which is 303-745-5525, 303-745-5525, or they can send us an email to support@successclasses.com, support@successclasses.com.
All right, very good. Thanks, Anthony. Again, I appreciate you joining us today, and I'm sure our listeners got great value from our conversation. Thanks again.
Well, thanks for having me on, Anton. And if there's any additional questions that your listeners have, they can reach out to me and I'll be more than happy to answer them. So thank you. And thanks everybody for your time.
Thanks.